Hi everyone, welcome and thanks for joining us this evening for our exclusive market update. For those who I haven't met before, my name is Ryan Dobbrick. I'm the Director and Principal Financial Planner at Liberum Financial. It's my pleasure to welcome you all as guests to our private update tailored specifically for sophisticated investors. So it's been a couple of interesting months since our last webinar back in May. There's more data coming through suggesting that the shift from transitory to structural inflation is gaining evidence. When you combine this with positive global growth indicators around the world, you've got an environment of increasing inflation and increasing growth. So it looks as though there might be choppy waters ahead. When you throw in uncertainty around China, and the crystal ball of the future looks as murky as ever. That's why I'm very pleased to be joined tonight by Dan Miles, Managing Director and Co-Chief Investment Officer of Innova Asset Management. It's the research and investment team behind our investment offerings. Many of you joining us this evening has probably heard of Dan before, or you've been enjoying his commentary that we share every week. If there's anyone as well versed in understanding what's happening out there, it's Dan. Dan's led Innova since 2010 and is responsible for overall portfolio management of Innova's managed account portfolios. He also oversees the design and refinement of the company's quantitative modelling processes based on their unique approach to managing investment risk. He's also a regular contributor to Sky Business News and other financial news segments. And Dan's an active contributor to media discussions on issues affecting the investment and advice industries. He's co-written a bunch of research reports on portfolio construction and research management. Dan, thanks for joining us. Really keen to hear what's happening out there and get your take on it all. Just before I hand over, just got a couple of housekeeping. Of course, everything we're talking about tonight doesn't consider your personal circumstances, is general in nature. I do invite you to reach out to me afterward if you'd like to chat specifically. Also today, I'd like to encourage you to ask questions throughout the session by using the chat feature. You'll see the small speech bubble icon in your meeting controls. Feel free to use that to send through questions, and I'll keep an eye out for these during the session. Then shortly after the session, we'll send an audio recording, and you're welcome to share with others you think might be interested. On that note, I'll hand over to Dan. Dan, firstly, thanks for having us. Great to have you. I know you have a lot of interesting insights to share tonight, but maybe first off, just give us a bit of background as to what's been happening up until now.
Yeah, well, let me just share my screen. Here we go. Okay, well, look, the obligatory disclaimer. And speaking on the media notes, if anyone's interested, if you've got the weekend before last's AFR, I was a contributor to one of the articles in there that was a reasonably interesting one on risk factors. So feel free to have a read of that. What we'll cover today, so the two primary things in the market that people are talking about and that we go through in our quarterly report are essentially Evergrande and the China situation. So I'd like to filter through, there's a lot of noise in regards to Evergrande. So let's go through some of the facts and try to filter out some of the noise and look at it from a realistic perspective. And the other real main topic of conversation is inflation and the move potentially from transitory to structural inflation and the probability of that occurring, and what does that actually mean for portfolios, since it's been 40 something years and since we've had a consistently rising inflation rate, and what that means translated through to client portfolios. So they're the two areas that I'll focus on today.
Hey Dan,
on the back of the
Dan, I'll just interrupt. Just want to full screen your slideshow there, just so we can see it all. Got the.
Okay, it's not full screened. All right, it should be. Just bear with me. Is that full screen?
No. What you might have to do is on the share content page, you might have to hit that again and then go to the full screen image of that slide. Should work.
Yeah. Let me have a go again. Does that work?
No, that's still a small. I'll tell you what. I can just share mine. You just give me a yell when you want me to change them. Does that sound okay?
Yeah. Why don't we do that? Yeah, that sounds fine. If we just start at slide 7.
7. Yeah. Yeah.
There we go. Okay, so we'll talk about Evergrande and China, and then off the back of that, we'll speak about inflation and what has recently occurred towards the end of October, particularly in Australia, in regards to rates and at the short end and the long end, and how the market is kind of questioning the RBA's, I guess, adherence to this yield curve control policy, and how committed they are, and how they may be forced to raise rates earlier than 2024, the way that they stated that they would, and what that has meant for the market, and what we've done opportunistically in the last week in regards to client portfolios, because we think we were prepared pretty well for this coming into it, and we think we've prepared ourselves pretty well for it coming out of it, but it's worthwhile clients understanding the nuances of what's occurred there. So if I start off with Evergrande, as I said, there's been a lot of noise going on. Before we published this quarterly, we wrote a weekly article in regards to this to try and filter out some of that noise. Evergrande is definitely currently the world's largest indebted property developer, with roughly $300 billion US dollars, or 1.9 trillion renminbi of debt. But if you put that in context of Lehman, which people are talking about this being China's Lehman moment, Lehman was twice as indebted as Evergrande was. But probably way more relevant than that is that the underlying assets that were supporting that debt for Lehman were, subprime mortgages to people that couldn't afford the mortgage. The value of the property was essentially nothing. Whereas Evergrande have 500 renminbi, so a quarter of the amount they owe is in debt. They've got in land and buildings in first-tier cities of China and other prime city locations. So they have real assets of real value backing a lot of this debt. And of the debt that has been issued, only 15 billion in US dollars is held outside of China. So for this to be a Lehman event, which is the implication that it is a systemic event that spills over to everywhere, well, only $15 billion sits anywhere outside of China. It is all inside of China. And what is only just starting to hit the press now, but we were talking about 4 weeks ago, was that it's not just Evergrande. Country Garden China, Vanke, Greenland China, they're the most indebted developers. Combined, they have 6 trillion renminbi, or 900 million US dollars of debt. So to allow Evergrande to just fail and not just let the equity and the debt holders fail, but to not support the retail depositors and the banks that have taken those deposits and that they're there for property development in the future, sets a pretty poor precedent as to what could occur for these other over-indebted property developers, because they're not in a position to be able to necessarily pick up those assets. So allowing one to fail without protecting the banks and deposit holders would be absolutely catastrophic, and flies completely in the face of China's common prosperity rhetoric, which is part of what's called their 14th five-year plan. And China, being a communist regime, stick very closely to their five-year plans. Their 13th five-year plan was focused on reducing debt. Now, clearly, these property developers thumbed their noses at the Chinese Communist Party and essentially went over their skis and over-indebted themselves. And any company that does that, I mean, we only have to look at Didi, or we could look at Alibaba, or we can look at any, the companies in China that, you do something that the Chinese Communist Party doesn't like, it's generally not a particularly good business model. So what we think is the most likely scenario is that this common prosperity will be the overriding factor. They recognize that 70 to 80% of the populace's wealth is tied up in property, very similar to Australia, actually. And to allow a property market crash would be absolutely catastrophic, because if you talk to native Chinese who live there about the concept of a property market crash, and they think that's the most absurd concept, they would just laugh at you. It's unheard of. The flow-on effects would just be catastrophic. So is that likely to occur? Well, I don't really care what mainstream media is reporting about this. What I think is most likely to happen is that the Chinese Communist Party is going to protect those retail depositors and is going to protect the banks, and they will take the companies that basically thumb their nose at them and became over indebted, and they're going to let them fail. They'll let the equity holders fail, and they will possibly let the debt holders fail as well. And as I said, if they let the debt holders fail, almost all of that debt is isolated in China, and is not, there's only $15 billion held by international businesses worldwide. That is not a systemic event that spills over to the rest of the world. So, I think that's a more factual way to and logical way to think about the scenario. But, there's other considerations as well, which, we might want to go on to the next slide. So, Ryan, you're going to ask if the recent pullback was the start of a bigger fluctuation or just a bump in the road.
Yeah.
Look, speculation that Evergrande is a systemic risk that will spill over to other markets, like I said, I think it's highly unlikely. It's not a probability of zero. There is a chance, but I think it's a very, very low probability. A property and GDP slowdown in China is basically inevitable. In fact, they've come out and said it. They've said that there is going to be slower property development going forward because there's just been too much, even though their 12th five-year plan was about building out property and the 13th was about trying to slow that property development down and then expansion into the second and third tier cities. Because of this over leverage, there will be a property slowdown, and it will lead to a slowdown in GDP growth. But that's hardly disastrous long term. I mean, we're talking about still positive real GDP growth in the 3 to 5% range. And it's only in one sector. It's not really going to spill over to other areas of the market. And the state has the power and the funding to support the retail deposit holders because they have such a large account surplus. They have more than enough funds that they can repatriate those assets, support their valuations, and then find other developers to deliver on the properties that have already been deposited with the banks for those retail investors so that they get the result that they needed. And it may be that there's some state ownership involved in a period of transition as they pass it over to other management. But I don't think that's a bad thing in any way, shape or form. And I think it can be well controlled in that environment because they really do not want a property market collapse. However, the value of the underlying land is substantial. So it's not like there's nothing there and it's all vapor the way it was with a Lehman Brothers, where there really is nothing that can be leaned on that has been borrowed against. There is real value to the underlying land holdings, and that is a key point of difference between what happened in Lehman, besides the fact that it was twice as indebted as Evergrande, and not only Evergrande, but these other property developers have very, very valuable property assets backing their debt that can be repatriated by the state and used to essentially make good for the banks and the deposit holders, ensuring that the retail and consumer is protected and the banks are protected, and it's just those bad players that over leverage themselves are the ones that get punished, because they don't have a history of supporting businesses that take advantage of them and act in a contradictory fashion to what it is they like. And China is also not averse to punishing management. So don't be surprised if in the next year or two you hear about them going back and actually forcing management, clawing back the bonuses that they earned by taking on this excess risk, which is something that if people think back to 12 years ago, back in 2009, people were saying should have happened to the investment banks in the US, but didn't. And in fact, if you think about what I've just described as a situation of allowing the equity and the bondholders, the ones who took the risk and knew perfectly well what risk they were taking, collapse, and protecting the retail investors who were not taking the risk and protecting them, as opposed to following the too big to fail mantra, this is actually a far more capitalist way of dealing with the situation than what we have kind of become accustomed to in the developed world over the last 12 odd years. That's not normal. That is not a capitalist system. What we're talking about in China is far more capitalistic than what has occurred in the Western world since the GFC. But given the situation in China, there has been some sell-offs in emerging markets surrounding them that have had absolutely no effect whatsoever to their companies, to their business models, to their earnings per share, yet their valuations have dropped, as I've highlighted here in this chart. You can see that there's been a drop in the emerging market index compared to the rest of the world that's shot up. That creates an opportunity, because as the price you're paying goes down and the growth prospects are essentially the same, the prospective return goes up because you're paying less for that prospective growth. So we think this is a reasonable opportunity. We yes, we understand there are risks involved. Yes, there is the potential for further spill-on effects. However, we think they're more than compensated for in the price that you're paying for the equities and the exposure that you're getting in these regions. And the specific exposures we have are not to any property developers. There is one insurance agency that we have exposure to that has no property development, and one regional bank that has no property development exposure either. So, our specific allocations in emerging markets that have a China allocation, not only are they underweight China, but they don't have any exposure to these problem areas in the first place. So if we just tick over to the next slide. So have you got any questions in regards to that, Ryan? Is there anything else you'd like me to elaborate on?
Yeah, just no, that's good. I guess the other big one out there is inflation, and just wanting to know what your outlook and what you're expecting, and how you're tilting portfolios to take advantage of it.
Yeah. This is a very interesting one in that we've had. If you go back to March of this year, you had 26 mentions of transitory inflation by Jerome Powell. Then in June it was 9, and then no, that's not right. In March it was 9, in June it was 6, and in September it was 0. I think the evidence is mounting that this concept of transitory inflation may be becoming more structural. However, I don't think it's a guarantee yet. What I think the evidence is suggesting is that global economic growth is strong. We're seeing strong PMI numbers out of the US. We're seeing strong PMI numbers out of Europe. We're seeing the basis effect of inflation start to filter through. So what I mean by the basis effect is that we came off a very low base because of COVID, and clearly there's going to be, in fact, if you could tick over to the next slide, it might help put that into context. The chart on the right shows the drop in inflation, from baseline of just above 0 down to -60, and it shoots up to 120%. And people would think, wow, from 60 to 100 to 120% is amazing. But in reality, to get back to trend, you actually needed to have gotten back to 150% inflation. So we took all 57 elements of the CPI, measured them prior to 2019, prior to COVID, and then cut COVID out, and then had a look at it in June of 2021. And as you can see on the left, there's barely any difference between the two. And it hasn't been until now that we've started to see earnings come through. And if I could flick back up to the slide above again, sorry, Ryan. We've started to see earnings come through stronger than expected, and we're starting to see PMI numbers come through stronger than expected. And a lot about inflation is that it's quite psychological. And if people expect inflation, they start to do things such as hoard and buy things now because they're worried the price will be higher later. And that almost becomes a self-fulfilling prophecy, in that their actions beget the inflation that may or may not have occurred. And I've got two charts here. One of them is on rent, and the other one on food, so food prices. Rent and rent equivalent accounts for about 42% of US CPI, and food about 15%. They're the volatile items that are stripped out. So if you strip them out, obviously CPI doesn't look very volatile. But if you add in the things that actually matter, it is very volatile. And these are expectations from the consumer. And you can see this enormous spike in 2021, where you've had a fairly constant expectation of price growth around 6%. In rent, suddenly jumped to 10. And in food price inflation, as low as 4, suddenly jumped to 8. And so there is mounting evidence that this inflationary component, and that we're entering into a high growth, high inflation, or what we call a reflationary environment, is not a guarantee, but it's a much higher, much higher probability of occurring. And I think inflation could be a game changer. It could be the great equalizer in portfolios, given that over the last 40 years, asset managers have been essentially accustomed to and conditioned for deflation because they've had a deflationary tailwind for 40 years. And if you've just been long bonds and in growth or high quality, long duration equities, you've made lots of money. In a high growth, high inflationary environment, that is not the portfolio that you want to be in. You want to be in a completely different portfolio. So if we scroll to the next slide and then maybe the one after that. So if I just jump over one more slide, that's the one. Sorry, one up. So in a high growth, high inflationary environment, which we think is the highest probability regime, we don't think it's a guarantee. We still do have the two killer Ds of deflation out there, debt and demographics. Those two are still acting on drags as on inflation. However, there is still mounting evidence that we are entering into a high growth, higher inflation environment. And so we haven't put 100% of client portfolios into that thematic or to that regime, but we do have a substantial tilt there. And that is being in value equities, emerging market equities. We've got some precious metals, we've got some commodity exposure, we've got investment grade floating rate exposure. We've reduced the duration exposure in portfolios. So by duration, I mean fixed income instruments that have high levels of sensitivity to interest rates. So if interest rates go up or inflation expectations go up, their price goes down. We've invested far more in those assets that go up along with rising inflation expectations and interest rates. But we don't have all our eggs in that basket because there is still the chance that we may enter into a recession or a deflationary scenario where you want some precious metals or long volatility. You might want some high yielding defensive currencies, which we have, and some long duration bonds and cash, which we also have. They're not overweights, they're underweights, but they're still there just as a hedge. And I think the top left that's the worst case scenario, which I think is the least likely to occur. And that is a recession with high inflation. We don't believe inflation will stay high and sustained unless GDP growth stays high and sustained. We think if GDP growth collapses through the floor because of another COVID wave or because of further lockdowns, we think inflation will become transitory and it will fall very heavily as well. We don't think we're going to see persistently high inflation with very, very low growth. We think the two of them will go hand in hand. And what we think is also a very unlikely scenario is that bottom right-hand corner where you have very high GDP growth, but no inflation with it. Basically what we've had for the last 10 years. And in fact, for the last 40 years, the great moderation where, you've had falling rates and increasing multiples and, fantastic yields, fantastic returns on just multiple expansion in equities and valuation expansion on bonds. There's very, very little to no evidence that we are going to enter into that regime in the next 2 to 3 years. However, if the evidence changes, we'll change our view and then we'll rotate accordingly. But right now, we have the majority of the portfolios tilted to the top right with hedges just in case of that top left or that bottom left scenario occurring.
Awesome. Hey, Dan, I know we've been chatting this week about some more unique investment opportunities that come across your desk. Do you want to give us a bit of a rundown on what you're seeing out there?
Yeah, absolutely. Some of them have been very timely and interesting. So I'll talk about the domestic bonds first, and then I'll refer to some other overseas opportunities. I've got here Aussie CGS. CGS stands for Commonwealth Government Securities. It means bonds issued by the Australian Treasury. They're known as Commonwealth Government Securities. So when you see that, it means basically Aussie sovereign bonds, not semi-government, not Australian corporate bonds. Literally things by the Australian Treasury. Up until mid to late October, the RBA was very firm on their yield curve control out to 3 years, where they said that they would keep rates fixed at 10 basis points. Then they reduced their repurchasing, they banned short selling, and they the amount of bonds that they issued to purchase at that 2 to 3 range was nowhere near sufficient enough to keep it at 10 basis points. And while they didn't come out and say, we're not going to be doing yield curve control anymore, the market took that to realize that they weren't going to. And then 2 days later, they stopped buying those bonds. And we saw, the yield on 3-year government bonds go from, 12, 13 basis points out to, 97, at the drop of a hat. And in fact, they got up to almost 1.5% at one point, and they've come down a little bit since then, which is quite a violent move, especially at that shorter end of the curve. So coming into this, in the risk-defined portfolios, Innova already had very short, what you would call duration or interest rate sensitivity in the portfolios. We were very, very underweight that. We had it basically, it's only 1/3 of what is a typical fixed income allocation. Normally you'd have half to 3/4 of it in those sorts of securities. We only had, 1/3 of it in there. We also had some holdings offshore, because prior to this occurring, if you go back to September, the Australian 10-year bond yield was about 1.1% and the US was about 1.3, which made no sense. Why would the Australian 10-year bond yield be 20 basis points less than the US when, inflation expectations are higher there? It's a more secure country. It's a bigger country. It's a more secure counterparty. It's a more attractive and more liquid bond. We thought that made no sense. And so we kind of diversified globally. But then with this blowout in the short end of the curve, we also saw a blowout at the 10-year mark where things went from 1.1 up to 1.3 and very briefly out to 2% and are now trading about 1.85. And so we took that as an opportunity to not only reduce duration in some portfolios where it was needed, it wasn't needed in the risk-defined portfolios, but in the more traditional portfolios, we reduced that duration in totality. And we even reduced the global component and allocated a small amount to what was now a more attractively relative valued domestic Commonwealth government security or Australian government bonds. And in the risk-defined portfolios, we've got those more attractively priced Australian government bonds already sitting there, yielding higher than their global counterparts. So I think we went into this pretty well. We made some pretty reasonably intelligent moves, and I think we're positioned pretty well going forward. If inflation does prove to be more than transitory and a bit more structural, we've got more in, no interest rate sensitive, higher quality credit managers, which are what are referred to as floating rate. And so if interest rates rise, or even if the yield curve rises and interest rates don't, the yield on the securities that they own go up with them. They don't get crunched by the price depreciation that you get with a fixed rate bond. Because if you think about a fixed rate bond, if it's paying 2% and inflation goes to 4%, so people need it to go from paying 2% to 4%, they have to halve the price of it to get a 4% yield. So the price drops in half. That doesn't happen in a floating rate security, which is why we have so much more in those securities, which we think is a more sensible position given the mounting evidence that inflation is becoming a more structural likelihood, but not a guarantee. Hence why we still have some in that duration bucket or interest rate sensitive bucket, just in case we go into that those doomsday recession deflation scenarios. So if I flick to the next slide, and I'll refer back to Australian housing in a second. Another one that we're looking at quite closely is actually UK equities. So that might sound like a bit of a weird one, because we do have an allocation to Europe, and one would think that the UK would highly correlate to Europe, but it doesn't. It really does act quite independently of Europe. And given that what has gone on with Brexit, and it looks like Brexit is going to be relatively clean and relatively positive for them GDP growth-wise going forward, the growth profile of the UK is not as it's not as good as the US's. They don't have as fast growth growing companies as as the US does. It doesn't have that huge tech allocation. However, if you look at the top, top 20, top 30 stocks in the FTSE 100 versus the ASX 200, it's not domestic banks and domestic materials companies. These are big global healthcare companies and insurance companies and, you know, oil producers like British Petroleum, for example. These are, you know, GlaxoSmithKline on healthcare. These are enormous, globally recognized businesses of extremely high quality that you're paying, you know, 1/3 the price of that you are for their US equivalents. And our analysis has shown that they highly correlate to value equities at the time you want them to, because value equities don't always perform really well. Value equities generally perform well in environments of a rebound and a reflation. They perform well in an inflationary environment because if you think about the pricing mechanism of equities, growth equities, so if you think of the FANG stocks, for instance, Google, Facebook, anything like that, people have priced their earnings out for the next 20 or 30 years. And if inflation is 2 or 3% higher, then that 20 or 30 years worth of earnings that you've priced into today is suddenly worth substantially less, because $1 next year is worth substantially less than $1 today. So $1 in 30 years is worth way, way less than what you thought it was. Whereas in a value company, you're only pricing in the next 2 years worth of earnings. So if interest rates go up, or if inflation goes up without interest rates going up, they're far less sensitive to this interest rate volatility or to this inflation volatility. And so that's what we want from our value equities if we think we're going into a higher inflationary environment. And UK equities act like value equities at that point in time. They did really well in 03 to 04 when value did really well. They did really well in 2008 when value did really well. They did, 2008, 2009, particularly in the rebound. Value took a bit of a hit towards the end of 2008, but UK didn't, thankfully. And you can see the correlation drop then because they didn't get hit as hard. And in 15, 16, when there was a value rally, they did very well, and they're doing very well right now as value is coming back, because people are recognizing that, you know, pricing earnings out for the next 20 or 30 years might be a bit of a stupid bet if central banks are targeting an inflation rate of 3 to 4% instead of, you know, the 1% we've had for the last decade. You know, you don't want to be pricing 30 years worth of earnings at a 1% inflation rate if it's going to be 3 to 4%, because the value of your stock is now only 1/3 what you paid for it. And so, yeah, it's not only are they cheap, but they act like value equities when we want them to, and they are very high quality businesses that you're not paying a whole lot for. So it's a bit of a weird one. It's not one that you would normally see in a typical portfolio, but it's one that we're getting a lot of focus and attention at the moment that we think might be a decent global diversifier in portfolios.
Thanks, Dan. Yeah, do you want to now sort of, everyone always asks, you know, interest rates and property prices are on everyone's mind. Do you want to sort of talk about those in Australia?
Would absolutely be happy to. So, look, property prices in Australia, I think some might argue against this, but I would say that it's largely off the back of the availability of debt. You know, you could take anecdotes from just about anywhere about who's buying properties at the moment and the level of leverage that they're taking on, and the fact that they can get, you know, fixed rate loans for 4 years at 2.5% or a 5-year loan at 2.8, you know, and they can get floating rate loans at 1.9. The serviceability on that is very, very high because the interest component is very low. However, as we have seen since late October, the market doesn't believe that the RBA is going to be able to hold out until 2024 to raise interest rates. And even if they do, the market has now, as you can see with this bond yield curve, has forced the cost of borrowing for banks up very substantially. And at some point, that is going to have to feed through to mortgage rates. I don't know when that is going to occur. However, I don't think that's going to bring on a massive property crash. However, I would not be surprised at all by, you know, as Chris Joy is talking about a potential 20% major city property market correction. However, he's talking about a 10% rally prior to that. So really, you know, 10% up, 20% down, you know, you're talking about a 15% drop, but from unbelievably high rates. You've already had, you know, a good 50% run up in the last 5 years prior to that. So we're talking to levels that are pretty reasonable. My concern is the amount of debt that people have taken on. If you are taking on the minimum 20% deposit and you have leveraged up that entire 80% component, remember that 80% debt is fixed. Your 20% capital on $1 million home, $800 of debt, $200,000 of capital, a 20% correction in that home value now means it's worth $800,000. That means you have no equity in that home whatsoever. You have to stump up $200,000 worth of capital. And so that is what it is that concerns me. It's not necessarily rising rates. It's that people are over indebted and have overextended themselves, and they're being actively promoted to do so by real estate agents. Because I know it's happening to me. They're doing it to me all the time. They're just saying, go to the bank and get more money. I'm like, look, I can borrow more, but that's not the point. The point is that, you know, I want to operate within a reasonable budget, given that the conditions that we have right now, we have no guarantee will be like this in 3 to 5 years' time, especially with the inflationary forces that are in play at the moment, which one would hope would lead to a transition of wealth from assets to, you know, the end consumer in the form of wage growth inflation. Because we've seen, you know, essentially, particularly in the US, almost no power amongst the workforce to be able to generate any reasonable wage growth inflation to be able to keep up with what's going on, and which is why the disparity in wealth over in the US is so massive, because asset owners have become so incredibly wealthy because they own assets, and people who don't own assets, the lower income earners, they haven't seen any wage growth inflation. If we can see this transition, inflation leads to a transition of wealth and power from those of the asset owners through to power in amongst the populace that have greater spending power, which I think is a great place to be. Then interest rate rises are not necessarily that big a deal, because whilst the serviceability becomes harder, if you have a higher wage to be able to service that debt, you can offset it. My concern is that you've overgeared yourself to a point that a property correction wipes out your capital, you know, and that could lead to a bit of a spiraling effect. But I don't think it's going to lead to an outright property crash. I think that's very unlikely. I think it's far more likely in the regional areas where you've seen people like me, you know, move regionally for the sea change. But, you know, regional and urban property is always far more volatile than capital cities. And so, you know, it would go along with the playbook to see that to be a far more volatile area. And so corrections in those areas could be far more severe than in the capital cities. But I wouldn't be surprised by a pullback, but I'm not predicting any kind of market crash. And in fact, I think that some healthy wage growth would be good for the overall economy longer term, because if you think about it, a healthier economy is one that has a sustainable amount of inflation that is backed by wage growth that can match it, so that people's spending power doesn't go down, and they are able to maintain their living standards, because it means that the inflation is fueled by productivity growth and wage growth. It's not coming just from bottlenecks and, you know, supply constraints. And so I think that is actually the hallmarks of a good, strong economy, which will eventually overheat and we'll enter into a normal economic business cycle that will eventually have to be slowed down. And, you know, we've been through this before. We may finally actually see a business cycle. You know, central banks have done their best to try and squash business and economic cycles over the last 40 years. I don't think they can do it. You know, we might see it again. Everybody's lived through it before. They're a normal part of a healthy economy.
Great. Thanks for your insights tonight, Dan. We've come to the end of our time. Appreciate your inputs, as always. Very interesting, your take on the world. I'd just like to let everyone know that we've recorded this this evening, so we're going to send this out in the next few days. We'll send also a link to Innova's latest quarterly report and outlook if you haven't had a chance to see that yet. Also, if you want to have a more detailed chat about anything tonight with Dan or myself, we're happy to do so. So feel free to reach out to me, and we can line up a phone call. Again, thank you for joining us, and have a nice night. Enjoy the rest of your week. Thanks, Dan.
Thank you, guys.